Tell me about this big push CalPERS is making into private assets.
Absolutely. You know, we're announcing moving forward into direct investing in private equity through new partnership vehicles that our board has just authorized us to begin.
You have long and existing relationships with the likes of Blackstone, KKR, and Apollo. Why take a different approach?
Well, we're going to continue those long-standing relationships well into the future. What we're doing, CalPERS has a 7% rate of return requirement, as we've talked about quite a number of times. Private equity is an essential component of our asset allocation in order to meet that target. It is our highest returning asset class over the last 20 years, and going into the future, we believe private equity is an essential asset class for us to move forward. And as a result, we've developed a comprehensive strategy to invest in the private markets at scale. As you know, CalPERS has $355 billion of assets, and as we look forward to construct a private equity portfolio, we know we'll need to build a portfolio of scale, $40, $50, $60 billion private equity portfolio. So we need a number of tools in our toolkits in order to access the private markets.
Why can't you do that exclusively with outside managers? Why do you need to go direct?
Well, again, it has to do with scale. We don't think we can invest at the scale that we need to solely in the traditional offerings of private equity general partners.
Because of the fees?
No, just certainly just the size and the amount of capital that's pouring into these relationships. We're not able to build a $50, $60 billion portfolio solely through the traditional general partnerships. That's number one. Number two, there's some real advantages to CalPERS to design alternative business models in private equity. Namely, we have a very long-term investment horizon. We have liabilities that we're looking to pay and invest for over 40, 50, 60, 70 years. Many of the traditional vehicles that we invest in have much shorter horizons, and these alternate vehicles that we're announcing today are going to have evergreen, indefinite investment horizons, and that will allow us to match our liability stream much more directly.
You raised an important question. Why should any public pension plan, let alone CalPERS, with the kinds of long-dated liabilities you have, continue to invest as much as you do in public securities? 50% of your portfolio is in public equities. You just raised your fixed income allocation to 28%. And even though you might have tens of billions going into private equity, it's still a fraction of your overall portfolio.
Well, the public securities are essential to our overall
But you don't need the liquidity.
Well, we do need liquidity over time, and we get paid for that liquidity provision. So I can't imagine any scenario where CalPERS or an institutional investor of our size can achieve our goals solely through the private marketplace. As important as the private marketplace is, we have to be investors in the public marketplace. It's also very efficient. Remember, we've discussed this many times. We're able to invest for basis points in the public markets, and it's a very cost-effective, very efficient way for us to earn and meet our overall 7% rate of return. Ted,
is the outlook for returns improving or deteriorating?
Well, it's a challenging environment for returns. You know, we've had a great run, and we continue to have this rally, this long-term rally since the financial crisis continues. So we've had a great year. Our calendar year return is a little over 11%. But looking forward over the next 10 years, as a long-term investor, we see muted returns. We actually think our portfolio, which is heavily invested in equities, about 50% of public equities that you mentioned, and additionally our hope to get another 10% invested in private equity, even with those equity-centric investments in our portfolio, we're estimating about a 6% return over the next 10 years. So it's going to be a challenge.
You won't hit your target.
Not over the 10-year horizon. And as we completed our asset allocation work, we're really looking to years 11 through 60 for some normalization of interest rates and otherwise to allow us to make that 7% required rate of return.
Ted, one of your projects as CIO has been to reduce the number of investment managers with which CalPERS does business. You started out with more than 300. You hope to reduce it to 100. Where do you stand?
We're about 138 today, so we've made great progress in achieving that goal. And in addition to that, it's not just about eliminating or reducing the number of strategic partners. It's growing very strong relationships with the strategic partners that we do business with. And that's been very successful in our real estate program, our infrastructure program, our private equity portfolio. We have much deeper relationships with this talent base that exists in the external manager world, and we're deeply involved and deeply appreciative of that partnership.
You're leaving CalPERS at year end to be closer to your daughters here in New York as it happens.
That's right.
That's where they're going to school. Any idea what you're going to do next?
No, I'm going to focus on closing this chapter at CalPERS. I've devoted much of my professional career to CalPERS.
Do you want to go back to the private sector?
I think that's the next chapter for me going forward. I've spent so much of my time in public service. I think going back into the private sector is a likely outcome. But my first priority is making sure this transition at CalPERS over the next 7 months is seamless and smooth and all to the benefit of CalPERS beneficiaries.
Let's talk a bit about the future for CalPERS after you're gone. This fund faces enormous pressure, often political pressure, to take an activist position on social issues. Should CalPERS be an activist fund?
Well, we need to be active in monitoring and managing the risks in our portfolio.
But that doesn't necessarily mean divesting of automakers, say, that don't heed the Trump administration's desires on emissions.
We draw a very hard line within the investment office and at CalPERS between divestment and actions that are politically motivated and those actions that we take because we're concerned about risks that could affect our portfolio.
Whether it's political pressure or something else, tell me what changes would make it easier for CalPERS and specifically the CIO to hire, to invest, and to generate returns for your beneficiaries? What would you like to see happen?
Well, much of what we wanted to see happen has happened. We've now internalized over 70% of the asset management inside CalPERS. We have an extraordinary investment team internally, mainly managing our public asset classes. What we've needed and what this announcement today in creating these new direct vehicles in private equity, it allows us to access the talent that we need to invest in the private marketplace. And we quite consciously did that in the form of a partnership with external talent, knowing that at least this point in time, it's not really feasible for us to bring that level of talent
because you can't pay for it.
We can't pay for it. We can't put the infrastructure necessary around the globe today. And as a result, we're really excited about the approach of partnering with talent to launch these vehicles.
Ted, given the challenge of generating returns, the fact that over the next 10 years you see it at perhaps at best 6%, I'm sure you hope for better. Given the pressures that we've talked about, given the constraints that we've talked about, in your opinion, is the defined benefit public pension plan model a sustainable one in this country, whether it's in the state of California or anywhere else?
Yes, I do. I fundamentally believe it is. We have incredible asset base and liabilities going forward. We've modeled our returns. We've modeled all the alternative historical events that could befall us, and we've built up quite a resiliency within our asset allocation, but there are risks. And I think one of the enormous challenges of a pension fund like CalPERS is not only investing, monitoring those risks, but also engaging in the public policy debate about what happens if an alternative path happens and it becomes more challenging.
I'm going to draw you into another debate. As I understand it, the reporting structure at CalPERS is going to change upon your departure. The CIO is going to be hired by and report to the CEO.
Yes.
Is that not dangerous? That's the same kind of structure that indirectly got Fred Buenastro into trouble and ultimately into prison because of the implicit pressure that the CEO comes under from unions, for example, right? And from lawmakers and from other interests in California to make investment decisions that benefit those interests as opposed to necessarily the beneficiaries.
Well, governance is primary, and the CalPERS board hires and selects the CEO under a number of criteria, but one of them is their integrity and ethics. Yes, we had challenges many years ago, and that choice was horrible. We have today in our CEO, Marcy Frost, one of the great young professional CEOs in the public pension world. She's fantastic. She operates with incredible integrity, and I have every confidence in her to govern the entirety of CalPERS and balance all of those policy pressures that happen at the intersection of CalPERS. And she's a tremendous supporter of the investment office. She's been a very strong partner in working through these alternative private equity models. And really our message to the marketplace is this announcement today is the considered work of the entire CalPERS organization. We've worked over a year with our board. I've worked quite closely with our CEO, and I'm very comfortable and very optimistic about this governance structure going forward.
Ted, I want to thank you very much for spending time with us. Listen, good luck wrapping things up at CalPERS and on the next chapter of your professional career.
Thank you so much, Erik.